Today we're going to talk about 401k rollovers. A 401k rollover is the moving of a 401k plan from its current custodian, the company holding it, to another. The following requirements must be met so that the 401k may keep its tax deferral status. The new 401k plan must accept rollovers. If you prefer, or if the new 401k plan does not accept rollovers, your original 401k funds can be rolled over into a traditional IRA. Rollovers into Roth IRAs are also allowed in some circumstances. The full amount from the original account must be placed into the new 401k or IRA within 60 days. If a lesser amount is rolled over, penalty taxes will be applied. Here are the types of rollovers for a 401k. 1. Direct rollovers. You can move the funds via direct rollover, trustee to trustee transfer, in which the funds are transferred from the old custodian to a new one without you touching them. This is usually the smoothest method because it doesn't incur tax penalties or withholding by the IRS. Self-directed rollovers are the second type. You can also remove the money from the old account and put it into the new account yourself. However, with this method, the IRS requires that 20% of the funds be withheld for tax purposes, even if you intend to roll the money over to a new 401k or IRA. You will then have to deposit the full rollover amount in order to avoid an early withdrawal penalty. This means you will need to come up with an amount equal to the 20% that was withheld. Once you have done so, however, the withholding of 20% will be returned to you by the IRS. The third type is beneficiary benefits. Non-spouse beneficiaries now enjoy a benefit they did not have prior to 2006. This is the ability to transfer inherited 401k and other qualified plan and IRA accounts into a new IRA. The transfer, though similar, is technically not a rollover, and it must be by a direct trustee to trustee transfer. In this case, the funds from a qualified plan, the new plan, must all allow such transfers. The new IRA must be titled as an inherited IRA, something like John Doe deceased for the benefit of Junior Doe. The non-spouse's beneficiaries, Junior's, Social Security number will be the one used. This arrangement allows the non-spouse beneficiary to stretch payments over his or her life expectancy to increase the deferral of taxes. The non-spouse beneficiary, say Junior, may name his own beneficiary, but this new beneficiary must continue to take distribution over Junior's life expectancy. Now let's discuss moving a Roth 401k to a Roth 401k. It should be noted that a Roth 401k can be rolled over tax-free into another Roth 401k. A traditional 401k cannot be rolled over tax-free into a Roth, however. Otherwise, those funds that were rolled over would totally escape taxation. Instead, a tax-free rollover from a 401k or other qualified plan can be made into a traditional IRA and then followed by a taxable conversion to a Roth IRA. Now that you've learned this information, let's take a brief quiz.